Paul, they say you can't touch your face like this.
Steve, you're alive.
We'll be live shortly. You're sharing your screen. That's good.
I'm seeing you on Facebook telling me to wear a mask. You already live, so we're starting at 9 o'clock.
Okay. I'm telling you.
No, we could hear you on Facebook. I think you can see you now on the Facebook.
Okay.
Hello, good morning, everyone. My name is Paul Gishero. I work at NCBA Investment Bank in the Wealth Management Unit. We are pleased to have you tuned in today via Facebook, YouTube, and Twitter for this webinar we have titled How to Build Your Wealth. We are honored to be hosting you once more on this webinar. That's part of a series we've been running over the last couple of weeks on how to invest. The topic we are covering today is as a result of your requests as our audience, and we are here to make good the promise. If you'd like to watch the past webinars, we are happy. You can find them on the NCBA Facebook and YouTube channels, and you can watch them at your own pleasure. I'm joined today by my colleague, Stephen Maleche. Stephen Maleche, who shall take us to kick us off shortly. We ask you to type off your questions in the comment section, and we shall answer them at the end of the seminar. Welcome, Steve.
Thank you, Paul. And welcome all of you to this webinar. On to the presentation. That's what we're going to cover today in the next 8 slides or so. Now, what steps do you take? You start first by having income set aside, saving. So saving is just the deliberate act of setting aside a portion of your income for a future known or unknown obligation. So you could have school fees to pay, you could even have a lease to pay at the end of the year, or you're buying an asset, or it could be in preparation for an opportunity. Then once you have that money set, so you invest. So investing it is merely injecting that money into a venture or a product, could be a financial asset that grows your capital and gives you a return. And at the end of the investment period, you probably get back your return and your principal, whatever you put in. Now, the other thing we need to define is, what are we calling wealth? Wealth is how many days forward you can live on your current, on the income, on the cash or income you have at present, without necessarily expending more effort to get extra. So it is not tied to a number. Wealth is tied to how many days forward you can live. So for example, if you have $1 million, but you spend 100,000 a month, then you can only live for 10 months. But if you have 100,000 and you're spending 1,000, you can see that is 100 months forward. So that is how we are looking at wealth. On to now your steps to building wealth. So as we've talked about, you need capital to start with the investment process. So how do you get that capital? First, you need to budget. So as you budget, through budgeting, you're able to identify what are your key income sources. Where does your money go? What do you spend it on? So once you know how much you make and how much you spend. So in some circumstances, it's very easy. If you're in employment income, it's very easy to know how much you make. And then you can narrow down on what you spend. If you are self-employed in some types of businesses, it may be hard to know how many sources of your income are there. You may be getting income, but you have never really calculated it properly or identified all the sources. So once you know how much you make and how much you spend, then you can now work out how much you can put aside. So that is saving. And once you're saving, now it's to work on the frequency. So how often do you want to save? Does your income come monthly? Then probably monthly saving would work. If your income is daily, you would have to look at daily. If it's infrequent, let's say a bonus or a one-off, when a project happens, you're a consultant, then your saving frequency would also have to match that so that you do not strain yourself. Then once you're saving, now the next thing is to identify the products or ventures that you can place your funds in to earn a return. So now when you're looking at that, now you're looking at your investment horizon, and it makes sense for you in terms of the risk and the return. So now we go on to look at what are the key considerations you should have when you're considering investments, because investments is not only financial, comfortable in that you understand. So the factors you need to look at are, one, your return expectation. So if you're investing for a year in the current circumstances and you want your money and your principal back within a year, then ideally your horizon would be around 6 to 8% per annum if you're in the Then the second thing is your risk, your principal. So if you invested 100 and the investment lost 20, would you be able to psychologically stomach it? Would you have sufficient financial ability to stomach it? So risk tolerance. Generally, higher returns go with higher risks. Then the third one, the most important one, is so if you need money after 5 years or in 10 years, then you can invest in much longer term periods when you expect to get sometimes your liquid returns and your funds back in that period. So if your money you're expecting to earn a return more than 5 years out, then if you're in real estate, you can wait out and get it within that time. If you require money within 1 year, then your money should be in more short-term investments, your treasury bills, your money market funds, your bank. So that's the most important one to know, because it's how much capital you have to invest. Then the fourth one tied to it is investment horizon. how soon do you want your money? In a week, in 6 months, in a year, after a year? That explains a lot. The fifth one, which is will determine also what investments are suitable for you. So for instance, you have infrastructure bonds. Most of the infrastructure bonds are usually tax-free. They are not taxable. So if you invest in it, you get a return, but you're not taxed. But they tend to be more long-term, so you go further out. If you invest in a bond less than 10 years, you have a withholding tax under the current regime at 15%. If it's more than 10 years, your withholding tax is 10%. So as you can see, your tax status and the tax status of the investments makes quite a bit of impact on your return. Then the sixth one is your legal requirements and restrictions. You have investments which are restricted to certain investors. So you could have foreign investments that are only restricted to residents of a certain country. You could also have local investments, which because of their risk profile are restricted to qualified institutional investors. So that matters a lot in terms of what kind of investment you're getting. Then the other factors to consider are tied in to the 6 other factors we talked about earlier, such as your source of funds. If your source of funds is a chama, then you cannot invest it as one person looking only at your options. You have to consider the other group members. If it's individual, then you have the remit to do as you see fit. Then the investment structure and ownership of the investment vehicle. Are you bringing it in individually? Are you bringing it in as a chama, as a limited company, as an existing business? All that factors in how the kind of investment you invest, the tax rates you will have, and what investment horizon makes sense. Then also your existing investment portfolio. It's always good to diversify and have your investments in several different investment vehicles. So if you're already very high in equities, then you would think of adding fixed income portfolio, which is your money markets, your bank deposits, and your treasury bills and bonds. And then usually you may also have other unique factors as an investor. you may be working out towards your retirement, so you have a number of years up ahead you're looking at. That debt, your retirement debt, has a lot of influence on what you invest. On to the next slide. If you look at an investment, any investment, from as complex as a cryptocurrency all the way to just straightforward buying a piece of land, it has 5 factors. One, it must have an acceptable return. So if you're investing your money for 10 years, then you can't get a return which is below 10% per annum. It's worth it. 2, it must have the ability to grow in value. So if you put in 1,000 shillings, after a period of time, it must be more than the 1,000 shillings you put in, and the return 1,005, 1,010, 1,100. 3, the most important ability of any investment is at the end of your investment period, you must be able to convert it back into cash with little or no chance of losing too much of it. But ability to convert your investment back to cash is the most important element, because if you have an investment that even doubles in value, but you cannot pull out your money, then that investment has not, you cannot pull out the return, and it has not earned what it should earn. Fourthly, you must be able to secure it, meaning you must be able to say you own it, own a title to it. So it can be your bank deposit certificate. It's the account notification and identification you have in unit trusts. It's your CDS account that you have for government fixed income. And then fifth, the last one, and also one of the most important ones, apart from being able to liquidate your investment back to cash at the end of the investment period, is it must be easily understood. any investment, no matter how complex, no matter how simple, anybody selling to you or you buying into it, you must be able to explain how you make the money, that you put in 1,000 and this is how it grows and becomes 1,500 shillings. That and liquidity are the most important factors. Now, what kind of investment opportunities exist in our markets currently? This is not an exhaustive list, but these are the most common investments that are out there. That you can invest from any amount of money. You can start as low as 5,000 and below and go as high as you want to. One, money market securities. When we talk of money market securities, these are investments which you can convert to cash in short term, either within a day or within a year, but usually within under 12 months, you can convert back into cash. These are money market funds, such as the NCBA money market fund, bank deposits, straightforward, your fixed deposit that you buy in a bank, your call deposit, the treasury bills, which are short-term securities sold by the government up to 1 year. They come in durations of 91 days, 182 days, and 364 days. Commercial papers, these are similar to treasury bills, only that they're issued by private companies. So private companies borrow money short-term for 30 days, 60 days, 180 days, 360 days from investors. Then you have your fixed income securities. Here we are talking about more longer term securities. So when you buy a treasury bond for more than 1 year out, they can go as long as 20 years, but they start at least 1 year out. Corporate bonds are the same. Securities issued by private companies for more than 1 year. Most of the corporate bonds tend to range between a year out to a tenor of about 6-7 years. Then we have stocks and shares. The most common one everyone talks about is listed shares on an exchange. So what you see on the Nairobi Stock Exchange and most of our neighboring exchanges, New York Exchange, London Stock Exchange, those are listed securities. Then we also have unlisted shares, business ownership. You can own a share in a business that is private, that is not public. So you're a shareholder, but you're not on an exchange. And as you know, once you own an unlisted company, there are also certain limitations. The key difference is on a listed share like Safaricom or NCBA, you can buy and sell it any day of the week through the stock exchange. You're on an unlisted share, you may have certain restrictions in terms of selling out. You may first have to offer to the existing shareholders before you offer to anybody else. Then you also have equity funds. So we have several of them in the market, such as NCBA Equity Fund. The equity funds essentially pull people's money together to buy listed equities on the exchange. It's also another more liquid way of holding shares, because if you went to the exchange, you'd only buy one share. So let's say you buy NCBA share, you buy only the NCBA Bank share, and when you want to get it, you have to go and sell that share. But if you bought into an equity fund, the equity fund would hold Safaricom, NCBA, KCB, EABL, BAT shares. And whenever you want to get out, you would only come and sell your units and you get your money immediately. And the fund would be able to give you an exit in a much faster way than holding one share only. Then lastly, the other one that's quite popular in this country is property. So you can hold land, or you can have houses, buildings, apartments, go downs, and this segment has actually grown. Now we even have parking. So parkings have become part of the real estate assets that are now available in this country. Next slide. Now, this is just a summary of what we've talked about, how to build wealth. The key thing is you start with income. So on the slide, it says employment income, but it can be any income. It can be consultancy income. It can be an inheritance. It can be a windfall. So you start with that. You put some of it aside, you save it. And once you save it, you invest it in a venture or a financial asset. It generates new income. And that new income now gives you an additional stream of earnings that is not tied down to your day-to-day activities, such that it's more passive. So Whether you wake up or not, it still comes. So that is how you build it. You start with the income, put some of it aside, invest it, it grows, and that new income stream adds now to your wealth. I'll now let my colleague, Paul Gisheru, talk to you about the products that we have.
Thank you so much, Stephen, for taking us through that section about how to go about investing. Audience, what we're looking at here is to illuminate on a few investment options that we have within the market, and especially those that can help you start off the journey in terms of investing. And I want to shed some light today on unit trust funds, a very popular term lately, but the one that has not been fully understood, and I want to probably put some light as to what unit trust funds are and how to go about investing in unit trust funds and even deciding which kind of unit trust fund works best for you. In general, unit trust funds are actually what we call chamas in a very formal structure. So it's about people coming together, putting their money together, investing that money in a pre-agreed way, and then that money generates a return that then you're able to distribute to the members of that fund. In different places, they are called different things. So in Kenya, we probably call them unit trust funds. If you go to the US, for example, you'll hear them talking about mutual funds. And generally, other jurisdictions will call them collective investment schemes. So you'll see these terms used interchangeably by different players in different markets. But the concept is the same, that we are all coming together, putting the money together and investing. Why do we think unit trust funds are really good vehicles to start off the investment journey? Simply because you may not need the expertise in any asset investment class to actually be able to start doing unit trust investments. Secondly, it doesn't matter how low your investment is, but you can start accessing investments that you may not generally access. Why do I say that? For example, if you find a unit trust fund that's probably investing in government securities in the form of treasury bills or treasury bonds, those securities require you to have a particular minimum amount. Unfortunately, if you're starting off the investment journey, you may not have that money ready for investment. And so unit trusts come and put all of us together so that with your 5,000 shillings, with your 10,000 shillings, all of us pile up all that money together and we're able to access, for example, the treasury bonds market. If, for example, you are keen to get to the stock exchange and you probably have 10,000 shillings, when you go to your broker, they'll ask you which share do you want to buy. And the likely scenario is that you either not be sure which share to buy, or the money you have may only allow you to access one share. Now, what happens with that is that, unfortunately, then the risk you live with is that you will always be exposed to that share. So I'll give you an example of a very strong company, Safaricom. If you only bought Safaricom shares, you live with the list that Safaricom poses. But a fund that's structured to actually provide equity listed shares exposure will give you an exposure across various investments. So it becomes a very compelling way to start getting assets that you may never have accessed, and assets that you don't have expertise on, and assets that you don't have space, even time to actually do due diligence. Because remember, all of us in this webinar actually have our 8 to 5 engagement, or are doing all sorts of things, including running our businesses. Nobody has enough time to actually start looking at, which shares to buy, which bond was sold yesterday and all that. And so you are leaving this to another person, the profession of money manager, to actually access those investments for you, put them in a structure that then allows you to make a return. And you'd allow me, then I'll want to go through each of the funds that, for example, we offer at NCBA. And of course, you'll find these in different, with different issuers across the market. Every time you open the newspapers, you always see there's a page called, the Financial Review that gives you all the people or the institutions that are doing unit trust. But I want to illuminate on what we are doing at NCBA just to give you an idea. So at NCBA, we have one fund called the Money Market Fund. And the way the Money Market Fund is structured is to invest in very low risk investments. Investments that in a way gives you comfort that the principal you invest is actually safe. So what we've done is to look for securities, including government securities, so we can buy bonds, we can buy treasury bills, we can buy fixed deposit with banks and can buy some bit of corporate bonds. And we've put all this together and they are generating a return. That return is then distributed to you on a day-to-day basis. So we, for example, as of yesterday, the pool could have earned, say, 1 million shillings. And then we take that and divide by the number of investors and then decide how much is distributed. The good thing about it is that the return you earned yesterday is actually your return and can never be reversed. That unlike, for example, other investments, and I can quote example, for example, of investing in a fixed deposit. If you invest in a fixed deposit and you say, I'm locked up for 3 months, but then you go after 2nd month because you're having a cash flow issue and tell the bank, I want my money back, then you have to get into a negotiation process to agree whether they'll pay you the interest you've accrued or they'll take a bit, you'll probably absorb some bit of penalty to liquidate your deposit early. Money markets, on the other hand, just allow you to earn the return on a daily basis and it's available to you. And then we've structured the money market fund in CBA is that all the interest earned within the month is available for reinvestment in the following month. So you can opt, for example, to say, I want to reinvest all my interest, or I want you to pay all my interest at the end of the month into a different account. So the reinvestment bit then allows you to start compounding your return. And I think if there's any magical formula as far as finances are concerned, is a formula called compounding, because it allows you to grow faster and over time. So that big advantage then moves you from earning what we call a straight line return to actually earning a compounded return over the time. In addition, this fund then allows you a lot of flexibility in terms of when you can come in, when you can go out. So that today you can decide, I'm investing 5,000 shillings. If something changes 2 days down the line and you have more money, you can bring it in, it continues earning. Or 5 days down the line, you can actually realize, okay, I had a need I hadn't thought about, I can pull out the money. It leaves you totally flexible. So very akin to your current account, but earning your return. But of course, that comes with a bit of friction. So you will not walk to your bank account and say, I want to pull my money from my money market fund. It's kept separate. But then what we've also done is to ensure that that money is accessible within very short notice. So in our case, if you issued instructions to liquidate your investment in money market fund in the morning before 11, that money is available to you around 2:30 in the afternoon, which makes it very flexible as a place to start investing your money. The minimum amount that you can actually invest is as low as 5,000 shillings, and you can top up at any frequency as you want. And so that allows you to start putting away some bit of money. So akin to what, for example, you say, I want to be putting aside 5,000 shillings in a chama, you can also be doing 5,000 shillings into a money market fund with whatever frequency works for you as far as your cash flows are concerned. The equity fund, on the other hand, then gives you exposure to the stock market. This is because most of us want to get to the stock market for our long-term savings, but unfortunately, we are not sure which of the stocks we want to buy. And the reason is because I'm not even sure whether Safaricom will perform better than NCBA or will perform better than KCB. So what you're doing here is to take the advantage of a professional manager to actually do all those decisions for you. And then it gives you a very diversified investment structure. So for example, the equity fund that we are running right now has about 14 different securities that we invested in. And so you're getting into an already diversified investment pool without having to think about which one to go for. And the good thing about it, then you can actually ask your fund manager, which will be ourselves, as to what have you invested in and why have you invested in those? And those questions we do respond on a monthly basis. We give you a synopsis of what you're investing. And on a full year basis, when you have our annual general meetings, we actually give you a rationale for why we've actually made particular investment decisions. The only caveat we always give about equity fund is that it's supposed to be this long-term investment vehicle that you actually use to grow your investments over the long term. So suitability, we always say, it's more suitable for people who want to invest for longer than 3 years, upwards of 5 years. And the reason is that we know the stock market. It will go through various cycles. Like, for example, right now, the stock market is very depressed. And so one who would enter today hoping to come out tomorrow may still find themselves in a trough or even have lost value. But generally, over the long term, the equity market tends to perform fairly well. And it's a good place to actually earn two types of returns. You earn a dividend income, and you also earn what we call capital gains, which is the growth in the value of the underlying shares that you've bought. So it's an alternative to going to the stockbroker to buy, units of stocks. And as you can imagine, if as I said earlier, if you had 10,000 shillings and you go to a stockbroker, then you have to have a conversation of which stocks do I go for. So this one removes that, that issue. The other thing I want to underscore is it's not that your money is locked in an equity fund, you can take it out, but we are always saying for risk management purposes and to ensure that you get the return that you ought to be getting, then you want to invest it for the money you can hold for the long term. So if you're thinking about, if you have a kid who's in primary school and want to take him to high school, these are good places to actually put money that used 5 years down the line. Then for someone who's looking for investing in dollars, we have what we call an NCBA dollar investment fund. And this fund allows you to start accessing a dollar return for as low as $100. This is equivalent of about 10,000 shillings, or in this case, about 106,000 shillings. Actually, not 10,600 shillings, not not 106,000 shillings. The reason for opting to invest in a dollar investment fund is because at times, and you're also thinking, the shilling could be at risk of depreciation. How do I shield myself from the risk of depreciation? Especially so if at some point you may need to spend some money in dollars. Then what we always say is it doesn't hurt in that case to actually put some bit of your money in the dollar investment fund or in a dollar structure. Now, this dollar structure in our case invest in, again, very low risk investments and is able to give you a return on a monthly basis and your money is not locked up. Very similar to what I said about the money market fund. What I always say is if you're the type that may need to travel each now frequently or you import goods from out of the country, you're probably doing trade in China, you're doing trade in other jurisdictions. It doesn't hard to have some money sitting or set aside in dollar terms so that you don't have to struggle thinking about buying currency when you want to, make that investment. Now, just to give indication of what kind of returns you're earning on each of these investments, the NCBA money market fund currently is earning a return of about 8.1% per annum, which if you compare to what deposits are doing generally in the economy, we are at the bank deposits are anywhere between 6 and maybe 7.5%. So it's a very competitive return for the moment. And so a comparing reason to put money there while knowing it's actually accessible to you when you need it. The dollar investment fund is currently earning a return of about 3.25%. A very good return as far as dollars are concerned, because we all know the trade-off. The trade-off of holding dollars is that you are getting a more stable currency, but unfortunately, because of global dynamics on dollar returns, then the return is always lower. But I can say 2.5% is a very good return for someone who's doing as low as $100. The equity fund is not one that you're able to project a return without accuracy. It's driven by what's happening on the stock market. But what I would be saying is that we're in a place where it does it. It's actually a good opportunity time to start entering the equity fund. And the idea here is as the market starts to recover, then you start getting value in terms of a return on your fund. Normally, I will tell you, if you want to start investing small, don't put all your money all at once in the equity fund. I probably want to spread out the risk a bit so that the average cost at which you're getting the equity fund is actually spread to the lowest so that you're not losing value as the market adjusts. So in a snapshot, that's what we are doing in the unit trust funds, fund section. I think it's a very compelling place to start doing your investments. And the one that we encourage anyone who wants to start investing to actually put some bit of money in. People always ask how is risk managed as far as unit trust funds are concerned. As you can imagine, it's certainly a concern, but what has happened, the industry has developed operational structures that helps in how this is done. So if you come and onboard yourself onto this NCBA money market fund, for example, the money does not sit with me as the investment manager or Steve as the investment manager. That money is held by a separate third party who is called a custodian. The idea is to make sure that the decisions of the fund managers are counter-checked by someone else. And then there's someone who we are all responsible to call a trustee, who then stands in your stead to make sure that no, we are not making any wrong investment decisions as far as investments are concerned. And then on top of it, we have an entity called the regulator. This is the Capital Markets Authority who has developed guidelines as to how we invest your money. so that we are not making decisions that are generally risky as far as your money is concerned. That structure really helps to make sure that your money stays, stays safe. We obviously keep evaluating the kind of investment decisions that are made, and there's a whole investment committee that has to review what decisions have been made by the investment manager. In terms of suitability, I'll tell you, this fund is suitable for anyone who has some bit of money to put aside, including individuals. Me and you can actually put aside, and I think from where we sit, we encourage anyone who has an income to put aside some bit of money in a unit trust fund or any other structure. It's available to your chama, the popular way of saving for us. So a chama should be able, instead of putting money idle in a bank account, for example, they should take advantage to put some money into a unit trust fund. Family accounts, I've seen families then trying to say, instead of just keeping money idle in a joint account, why don't you put some money in unit trust funds? Your business can take advantage of that, small and large businesses and institutions as well. So at whatever stage or whatever you are doing, then it doesn't have to put some bit of your money in a relevant or suitable unit trust funds, just to make sure that your wealth continues growing. As I come to a close, and we'll respond to your questions and continue raising them, we will respond to all of them. As you make investment decisions, it's actually good then to ask yourself some fundamental questions as you start the process. What is the objective of the investment I'm making? Why am I making this investment? In essence, it's asking ourselves, and I use land as a typical example. Why am I buying land in, I'll use a popular locations nowadays, Kantafu, Gong, and all that. Why do I buy this? Why do I buy this asset? What I'm trying to say here is investing itself is not an end objective. We need to define, or you need to define for yourself, what is the end objective I'm trying to achieve as I make this investment? Because it is that end objective that helps you define which of the many assets that Steve was showing us earlier works best for me. You will not go, for example, for a money market fund investment if your intention is to save for retirement and you are 24 years old. You'll probably be shortchanging yourself. Neither will you go for a pension fund investment if you are saving to take your kid to school in the next 5 years. Those investments, those objectives are the ones that actually help you decide, what do I pick in terms of building my investment? And I've just tried to put a few investment objectives that you could be thinking about that could guide what investment you want to go for. So, for example, if you're investing to accumulate money towards a spending need that you have, then generally you want to go for short-term investments. So, for example, schools are closed right now, and we know schools will reopen in January. If I'm putting aside money to pay school fees in January, then I want to buy an investment that I know will make money available in January. And so in that case, you'll probably be looking at investing in a money market fund. You'll be looking at investing in a fixed deposit with a reputable bank. You'll be looking at investing in, for example, those who know about it, Shwari and those kind of investments, so that you're trying to align your planned spending to where you're putting your money. That ensures that you don't get into any kind of complications to access your money. And you're also not taking a risk for money that you ought not to be taking a risk with. So accumulation for spending, then put your investments in short-term investments. If you're holding, for example, to invest into another, to buy another investment, and I take an example, for example, someone will say, you know what, 4 years down the line, I want to have a house. And because I don't want to go to a bank to borrow, I want to accumulate this money somewhere. So if I have that as an objective at the end, then I'll look for where do I start putting that money now so that it can lead me to that 4 years horizon. So think about it. For example, you might decide, for example, to go very low risk and put it in money market. But you might also decide, you know what, I know the government of Kenya does bonds, as investments. So can I look for a bond that would have a tenor, or a tenor that, for example, would align to my planned spending, so that I put that money there, and then it will continue giving me interest over that period of time. And 4 years down the line, I can either sell that bond, or that bond will probably have matured, and I can take my money out. Or then what I'm trying to underscore here is, you should be able to then align your investment objective with the investment structure you go for. If, for example, you're investing to grow your assets, and this is very important for all of us, and especially so if you're in an age bracket that's not tending towards retirement, growth is very important because it is that will assure you that your net worth is growing and you'll have stability later in life. Of importance is to always ensure that the investment you have is beating the level of inflation in the economy. So that if the inflation, for example, is reported, I'll use the current numbers, about 4 to 5%, then you need to make sure that the investment you are doing to grow your assets over the long term always beats that inflation. Because there are two elements to growth of assets. You may retain the shilling value of the asset so that you start with 10,000 shillings and end with 10,000 shillings, you've not lost anything. But there's also the loss of the purchasing power of that shilling. For example, the 100 shillings you had last month would have bought you fuel at 89 shillings and then left with pocket change of 11 shillings to buy, maybe whatever else you have bought. But this month, that 100 shillings unfortunately cannot buy you exactly 1 liter of fuel and you have no other money. So inflationary tendencies tend to, completely somehow pull down the value of your shilling. And that's why I'm saying any long-term investment you make should be able to obviously weigh off what inflation is. So the kind of assets you'll be looking for here will be, can I get long-term or medium-term investments that in a way assure me that I'm beating inflation? And that's advice you're able to provide on an ongoing basis. So this could run anywhere from buying stocks in the stock market, buying a business, investing in a business, investing in a good property. And I say good because properties can also have their own pros and cons, especially when you're buying them. So it's deciding what best investment do I go that can give me both capital gains and compound my income. Capital gains, like I said, is appreciation in value, and compounding of income is reinvesting the income that property or that asset is generating. So that's when you start looking for a bit more risky assets. Am I buying an asset for diversification? Diversification is, I think the adage, don't put your eggs in one basket, holds true always. That and I will use a Kenyan example. Most of us will have 1 or 2 assets in land, and unfortunately or fortunately, those assets either have appreciated in value and end up forming a very huge portion of the assets that we own. And you probably realize some people will probably have 60 to 80% of the assets sitting in 1, 2, or 3 properties. But the essence of diversification will be, can I start looking for other ways of reducing my wealth concentration on either that business or on that property? So if you're investing for the diversification, then you have to define exactly what risk you're trying to manage by getting another investment. And that's why then advice comes in. So that one is able to tell you, okay, you look for an investment that gives you a consistent return in the form of interest, or look for an investment that's totally unrelated to your business. And I say, for example, if you, for example, you supply telecom materials as a business, if you always restrict your investment, say, to investing in Safaricom, you're certainly in very familiar territory. But what is happening is that all your investment, unfortunately, seems to be related in terms of risk. So the idea here is to look for another investment that's not very well related to the current investment that you have, so that you reduce your risk concentration in that investment. And that applies across, across assets. So for me, for example, works in a banking environment, is my wealth all related to banking? Have I bought all banking stocks? Can I look for something else that is unrelated to banking that can keep me in a strong, a strong footing as far as wealth is concerned? The other item is about long-term goals, and this is probably you're planning for education, constructions, retirement. I think this one, I think you have to really link what goal it is to the kind of right investments. And if I can touch on retirement, then which is not a very popular conversation in this country. If you're planning for retirement, then it's good to start thinking about what pension structure could I pick that will lead me to that, to that retirement. So that at the early stage, I start putting aside enough money that will ensure that by the time I retire, I am able to replace the income that I've been earning, and I'm able to actually meet, my retirement cost of living after that. If you're doing it for construction, I think I alluded to that earlier. If you're doing it for education, then link it. And these were the issues, matters like buying insurance covers also become very relevant, so that you're deciding what insurance cover works best for particular circumstances, and you start saving towards it. Then there are people who actually want to do tax management. I think, well, Steve alluded to this very well, that there are different investments that give you different kind of tax exposures. So for all of individuals in this, we are subjected mostly to about 15% withholding tax on anything we invest in the form of interest income, and your business is subject to up to 30% with up to 30% tax. So what you're looking for is also look for an investment that can reduce the tax exposure you have, so that by and large you're not paying KRA 30% tax. You're probably reducing your tax legally, to a lower and acceptable number. With all these objectives, of course, there's no point at which you'll be saying, I'm just dealing with one objective. No, most likely you're probably dealing with multiple objectives. And that's why then it's very important to think about how am I putting all these assets together so that I am not compromising on one objective or really biasing myself towards one objective. Because all these things will actually have to come into play for you actually to say, I am creating wealth. I am creating my, my well-being financially is actually well taken care of. So that's why we say it's good to think about multiple assets and how all of them stack together. If you don't put it in that, in such dimensions, then you probably find yourself really biasing yourself, say, towards land, or biasing yourself too much towards money market investments, for example, easy to access kind of investments at the expense of long-term growth as far as your investments are concerned. And just as I cap it, I'll probably just then improve on us. There's certainly some also other things, behavioral, that we have to think about when it comes to investing. There's a tendency that by human nature, we tend to get to call herding or investing as a herd. And those are tendencies that got us mostly going for, for example, real estate investment, most likely buying that real estate in very concentrated zones. So my idea is that my advice would be every time we go for an investment is that you're going for an investment that you're not buying because others are buying, but you're buying because you appropriately know how it fits into your objectives. So that I'm not buying land for the sake of just buying, speculating, but I'm buying land because I know in which facet of my investment framework that piece of land fits. That in a way then starts getting you in the right kind of path and avoids getting us all burned. And we all know how then, Ponzi schemes and a lot of schemes that have been hatched by people have hurt people in Kenya because all of us went into them in the form of in herds, just to realize that it was actually a long investment. So for you, it's then, can I define where it fits? And one other rule to think about, when the return looks so good for what every investment is doing, then it's probably time to think again so that you're not getting yourself into a hole that's really hard to come out. Then, of course, advice on investing for sentiments. I think something to be very cautious about. Investing for sentiments and pulls you off from your long-term plans or from the key objectives that you want to achieve. So the question is, even as you get to that investment, what exactly is your rationale to get to that investment, so that you can then decide, do I want to be in it, or am I just doing it for for reasons that are sentimental? And I say that because the investments that we've gone into, because our friends thought they're really good, and we actually felt it's really good to actually hold that investment. Last one is doing proper due diligence in the investments that you're making, so that you reduce the element of surprise once you've invested. The idea here is that I don't want to buy the NCBA money market fund, then 1 month down the line, I'm actually getting very frustrated because what I expected and what I'm getting are two different things. And it's about asking questions and getting those questions answered, and really leaving yourself comfortable that you've got enough information that can help you decide whether the investment is the right one you want to get to, or you want to avoid it. So I would want to stop it at that. Obviously, we are happy to actually take up any questions that you have raised, and feel free to continue putting your comments on on Facebook or Twitter, so that we can respond to all of them. Thank you so much for the audience you've given us. If you want to, for example, subscribe to any of the funds that I've talked about, the process is quite straightforward. If you go to our website, which is part of this presentation, you can see it at the bottom. Then you can actually access the application forms, and you'll find our contacts there as well, that you can reach us out, and that we can help you in the process. Thank you so much. I would want us to move to the questions that you have raised, and we'll, between ourselves and Steve, we'll try to respond them as they come. And the first question I'll ask Steve to respond to is coming from Ndiki John on YouTube. And he asks, what's the difference between a speculator and an investor? Steve.
Yeah, the key difference between a speculator and an investor is time horizon and reasons for investment. A speculator tends to be more short-term, and they buy because they think they can get a better price for it. It doesn't matter if the company is doing well or collapsing or whether the investment will do well. They buy it short-term. They believe there's somebody who will buy it from them for a higher price. And an investor tends to invest for certain reasons. They think it will grow over the long term, will grow their capital. Maybe they can end up owning the business if you're looking at an equity type of investment. So the key difference is that duration and focus.
Good, thank you. A second one for you, Steve. What kind of investments are most appropriate for a senior citizen? This is from Jerry Kangede on YouTube.
Good morning, Jerry. The suitability of these investments would actually depend on your circumstances. Age is just one, but you can all be citizens, but with different requirements. The first thing would be just to try our risk tool we have on the website. We'll send you a link. The other thing is that you can just give us a contact and we can talk to you offline once we're out of this call to just know what fits your requirements.
Great. I'll also request you to take this one. Please share more information about commercial papers, and then can you expound on rates?
Yes. Commercial papers are debts issued by private companies, short-term debts. They're usually below 1 year. Most of them tend to be 90 days, 180 days. So it's essentially you're taking the debt of a private company. So instead of a private company, let's say a supermarket, a business like a hardware business or a paint factory coming and borrowing direct from the bank, they can't borrow directly from you as an individual. So there are two things about it. Usually it's limited to amounts of at least $1 million. You have to have lots of $1 million shillings. Two, you're taking on that risk as an individual. And given, you also have to remember where we are at in the economy. A lot of the loans to the commercial side in banking sectors have been restructured. So yes, they're there, but they have much, much higher risk. We've seen quite a number of the commercial papers default in the last 24, 36 months. The other one was on treasury bills.
It was rates.
Rate. Yes, I saw the question on rate. We actually don't have a rate at the moment as NCBA, but there is a rate in the market. The rate that exists in the market is what was formerly the Stanley Fahari IREIT. That is now being managed by ICEA Lion. So we don't have it at the moment, but a rate is essentially the same thing you do with unit trust. So you pull people's funds together, you buy property, and then you earn a return from the property and share among the unit holders who own shares in that fund.
Great. There's a series of questions here from Kareb Karanja, Ririan, and K and Tony Wainaina about investing in unit trust funds. I underscored that we can actually assist you in investing in unit trust funds. If you go to our website, you'll find the application forms that you can actually return. There's a bit of information request that we'll do. So by going there and reaching us out, we can actually be able to assist in setting up either money market fund, equity fund investment, or any other unit trust fund that you'll be looking at. Someone is asking whether we have guaranteed interest on money market funds. We do not guarantee interest because, as I said earlier, this is a chama that has put investment together. So it is a return earned by that pool of investment that we distribute. So you're not able to guarantee investment from that because the return that we are paying out is actually derived from the investment. But the role and the reason you pay a fee for NCBA to take care of this is so that you can actually make sure that the return that you're getting from this is very predictable. And if you're able to, for example, look at the historical return from the CBA unit trust funds, you can see a lot of predictability in that return because we set out to actually make sure that you're deriving a return that you can actually predict, and that's not too volatile. Steve, please expound more on treasury bills.
Yes, treasury bills are short-term borrowings issued by the government through Central Bank of Kenya. So they're issued in tenors of 91 days, one each days, 364 days. Now, if you have to buy a treasury bill, there are two ways around it. One, you can open a CDS account at Central Bank. The other one, you can go through an asset manager who will buy on your behalf. So we also offer that service. So the thing about treasury bills is that they are short-term, and as you know, short-term interests are not that high. So if you look at treasury bill interest rates right now, you will not go beyond 8% for 1 year.
Good.
But we can answer questions if you get in touch with us. Yeah.
Great. Engineer Mwangi is asking, what are the hidden costs and in money market investments? And then Florence is asking whether money markets fund investments, also called deposits in NCBA. Call deposits and money market funds are different, but function in very similar ways. A call deposit is one that you place with the bank, and you have to give the bank notice that I'm taking my money out. And that notice may be as short as 1, other places up to 7 days, whatever, depending on what everyone does. This is a deposit directly from the bank. The money market fund on the other side is actually an investment, a pooled investment managed at a different framework and regulated differently, by the Capital Markets Authority. But in terms of derivation of return, they actually follow the same metrics. Though a call deposit may have a fixed rate of return for the period of call, money market fund return is determined by the return earned from the underlying investments. So there'll be different assets, and it's always good to then be sure which one you are going for based on your particular circumstances. But more often than not, you actually realize they can be used very interchangeably based on whatever circumstances you're dealing with. Can I invest in money market in unit trust funds for my kids? Yes, you can, but what will happen is they will be beneficiaries of the investment that you're making, because unfortunately kids cannot contract as yet, just as they wouldn't be able to open a bank account. So what we'll do is we'll probably open an account in the name of Paul Gishero the son. And the idea here is you are the one who's contracting, but we know that money is assigned to a particular person. You might decide to place restrictions as to how that money is applied, so that we also remind you that this money is available, should be locked in for a whole period of time. But yes, you can actually do it for your son. Steve, someone is asking, this Samuel from asking, how would someone working in United Arab Emirates invest in money market fund while still there? And another one is, if I put money in unit trust funds and I have an emergency, how can I access it? Steve.
Yes. So for the individual who's working in the UAE, he would just contact us and we would see if he meets the KYC requirements. And if he meets the KYC requirements for investment into the fund, then he can invest. And how to get the money into the fund, the bank accounts here, you can send them through the normal transfers, the normal SWIFT transfers into the bank account, and then they would be credited into your money market fund for investment. But, and if you met the KYC requirements, we would also assist you open an account here, because you would need the account for ease of operation of the money market fund.
Great. There's another question about, is the 8.1% on your unit trust net of fees and taxes or gross? And I want to link that to the earlier question, probably they forgot to answer, about whether there are hidden charges. Now, the way the fund is structured is that the whole fund earns a return. That return is subjected to, of course, expenses of the fund, including management fees and other expenses. And then we declare the return that's available to investors. So for example, if the fund was earning a return of, say, 9%, and then we net all the management expenses, we are left with a return of 8.1% available to investors. So the return we declare every day is net of every charge. So you not see and every expense. So you not see another expense called management fees being levied on that. The only thing you will be subject to is taxes. And taxes here, remember, are applicable on the investor because we know what the tax law says, all as an individual is subject to taxation at a particular rate. So I declare the return as earned by the fund, but because you are taxable, then we'll subject your return to 15% withholding tax. If you are not taxable, and we know there, for example, organizations are not taxable, there are individuals, because of one or two reasons, have been exempted from taxes, then those ones can actually earn a return at a gross level, and that will be 8%, 8.1% gross. So it depends on your tax characteristic, but the return you will see on the papers for us is always net of taxes and gross of withholding taxes. And that seems to be the direction the whole industry is moving towards in terms of how we declare returns. Is it possible to contribute on a monthly basis? Yes, you can contribute on a monthly basis. In actual sense, we encourage people to do standing orders. Standing orders so that your money actually churns outright. And this facility is also available even, for example, if you're doing M-Shwari investments, other investment, you can actually do a standing order that ensures that you push your money on a continuous basis or at frequencies that you're comfortable with without having to really stress yourself. You can top up the money market fund at any point in time. You can do it 5 times, you can do it 20 times, whatever frequency you want. Even withdrawals, our money market fund doesn't have restrictions as to the number of withdrawals that you can do on a particular month. But of course, for reasons of making money out of it, we encourage you to reduce the number of withdrawals you do so that you can actually reporting some growth. Steve, this is from Angie for you, Angie on Facebook. She asks, are our investments protected in case of a market crash?
Right. I'd like to answer it in another way. It depends on the product you're in. Whatever product you're in, whatever investment you're in, you face the risk of that aspect of the market. So if in the equity fund, you face the risk of the equity market. If the equity market goes down, you experience a bit of that. But hopefully due to better management, you don't go as far down as the market goes down. Now, if you're in the money market fund, you are not experiencing the risk of the market going down. You're experiencing the risk of all the other counterparties we have, because the money sits in government securities, so treasury bills and bonds. It sits in bank deposits, so you experience that risk. So it depends on the kind of market crash you're talking about, but I suspect you're talking about an equity market crash. So if in the money market, you don't experience that, but if in the equity fund, you would experience that.
Good. This is Anna asking, Anna from YouTube, am I able to invest in various products despite not having a bank account with NCBA? The answer is yes. For the investment products we've underscored, you don't necessarily need to have a bank account at NCBA. We can link it to any bank account around the country. I'll just underscore what the value of having a bank account with NCBA is. If you came and gave us a liquidation or a notice to pay back your money in the morning, if you tell me that you want that money the same day, if you're an NCBA, I'll assure you that you'll have your money. You'll have your money by 2:30 in the afternoon. That's for sure. But if you have your account with another bank, most likely the money will come to you the following day. So there's some bit of friction in when you are doing it through another bank, but that does not restrict you from being able to invest. We certainly encourage you to align that so that the investment is done within NCBA, but no restrictions to that. Does NCBA offer opportunities to invest offshore? Yes, we do offer opportunities to invest offshore through our partners. This is one that we want to consider on a case-by-case basis. So we would want to understand what your objective is as far as investing offshore is concerned, so that then we're able to advise appropriately. As you can imagine, offshore investments will probably come with restrictions about the amount of money you might be investing. So I would encourage, this is Lucy, to speak to us so that we understand what you're seeking to achieve. Then we can actually be able to advise on what appropriate structures we can actually use for offshore investments. Then Karo Gashir asks, which would be the best investment for someone who does not have a stable source of income? Steve, do you want to take that?
Yes. If you have income you cannot predict, the best investment would be to keep it in a money market fund, because you can take it out at any time. So just linking this with the other question where somebody asks how soon can they get their money. If you ask for your money by 11 o'clock on any working day, you'll have the money in your account on the same day, if it's an NCBA account. If it's an external bank, probably by the following day. So remember, if you have unpredictable income, then you might also have unpredictable expenses. So a money market fund would make the best sense.
Okay. Hello, Steve. We lost you momentarily, but I think you just to underscore, you mentioned that a money market fund would be a good place to start to invest if you have an unstable source of income. Mimi Arts from YouTube is asking, can you talk about equity release? In real estate and realize the need to diversify. We'll make an attempt to discuss. I'll make an attempt to discuss equity release, and I agree with you. If you are really into real estate, it's time to actually think about other options to actually diversify. One way of releasing value out of equity of real estate is actually what you're calling equity release. And generally, equity release applies when, for example, you have bought an asset through a mortgage, and that asset has probably appreciated in value over time, and so you can go back to the bank and remortgage that increase in value. So that if, for example, you had bought a property at 10 million shillings, you've repaid your mortgage down to, say, 7 million shillings, then that property then appreciates 12 million shillings. You've actually created an additional borrowing room for about 5 million shillings, of course, subject to the bank's evaluation as to what level of borrowing they can give you. It is then that money that you get out and invest in other securities and continue servicing that mortgage. That is possible across banks, and I know it's possible across, for example, within NCBA. Obviously, subject to the right kind of due diligence that bank will do, or the kind of right kind of credit evaluation that the bank will do. It's certainly something that we can pick up, or you can pick up with a property division to actually help you on that, and we can do that evaluation. The most important thing I would say, if you are doing that to diversify, then you actually need to think about the cost you'll pay on the mortgage vis-a-vis the return that you're creating on the the new asset that you're creating, so that you're not paying a mortgage at, just for argument's sake, 13%, and then earning a return of 6 or 8%. You're not necessarily creating value, you'll probably be losing value. So something to think about, but it's something that banks are willing to do, and something that I'm sure NCBA is able to do. So should you want to discuss that further, we are happy to have a conversation on it. Minimum amount for entry, I'm assuming this talks about unit trust funds, and underscored. If you have 5,000 shillings, you can actually buy our unit trust funds. If you have $100, you can actually buy our dollar investment fund. For other investments that we facilitate including treasury bills and treasury bonds, for reasons of efficiency, we've defined 1 million shillings as a minimum entry amount, just to make sure that it makes sense from from a cost benefit analysis, even for for you. Steve, this is for you. This is from Shiro on YouTube. And she's asking, please tell me which is the investment bringing the highest return for, say, 1 year period.
Yeah, thank you, Shiru. I'd rather not be prescriptive and tell you which has gotten the highest return. You haven't missed it. We didn't talk about returns, simply because investments tend to be more forward-facing than backward-facing. So what earned a good return last year might not earn a good return next year. But if we were to start from today, we say today is day one, and we look 12 months out, what are the expected returns given the current circumstances? If you look, fixed income will give you anything between 7 and 10% per year, depending on how much risk and what kind of products you put it in. If you look at equities, 1 year out from today, that will be June next year. By June next year, if equities recover, you could probably be back at zero, just above closer to a single digit between 1 and 5. Because remember, for the year to date, equities are down at least 20% or 25, depending on which index you look at. So rather, the best thing would be to look at and see what are you interested in investing in and what fits your risk profile in terms of return and when do you need your money.
Great, thank you, Steve, for that. The last question, just in the interest of time, is from James Mwangi. He's asking, can I withdraw from M-Pesa? I assume this is withdrawing from my unit trust funds into to M-Pesa. I'll say at this point in time, we don't have a facility to withdraw into M-Pesa. All the investments are linked to a bank account. But I can tell you this is something that we are looking at, and in a very nearness of time, without giving a date, I'm sure we'll be able to start transacting through M-Pesa. Having said that, you can actually invest directly from M-Pesa using our pay bill number. We give you an account that you can do that, and the money goes directly into your investment. So we are working towards enabling you to actually withdraw into M-Pesa in the future. Thank you so much for the good questions and for your participation in this session. We'll be happy to continue with this conversation on Facebook, YouTube, or Twitter, and obviously even reaching out on the contacts that are available on our websites. Thank you so much for making time. We really appreciate, Steve.
Thank you all. Have a nice day.
Thank you so much, and all the best. Bye-bye.